Hello, Bill. This is the nth time I'm doing this one because I've had my screen recording software mess up a couple of times. And let's see if I can get this out in one go before this messes up again. Okay, so for my final visualization project, I am doing some financial stuff. I've been kind of working with a friend for a little while, trying to develop a tool that does asset allocation for portfolios. The theory behind asset allocation has been done in the 50s. It's what every hedge fund uses, every ETF. Basically, it's a set of algorithms that lets you determine the weight of an asset for a portfolio for an expected return profile. So kind of before I get going in earnest, I should talk about a couple of things first. The first being how you determine the risk of an asset. So when you have a stock, and I think I can just do this really quickly here. Probably should have done this first. Let's take Google here, for instance. So let's say, let's insert one goddamn chart. Scatter with lines. Select data. Okay, so we are going to select Google here. We've got a bunch of historical data for a couple of stocks that we've used just kind of as like dummy test data for our application. So here we have a nice chart of Google from sometime in, it's American, so that's September in 2015 into 2018. And we can see the stock price varying over time. Now, trend line here. Cool, trend line. Trend line's not exactly, but it's close enough to our mean here. So what we see is while the data varies away from the line, there's a general upward trend. So we know this asset is gaining in value over the 3 years we've been looking at it. So the way you determine the risk of an asset isn't by your expected return. Your expected return is going to closely go along the mean here. It's your expected return by the variance or the standard deviation of the stock. You can see here that it doesn't match the line. We don't at any one point, well, actually we have a couple of points that intersect the line here, but if we were to sell on any given day, we're not necessarily going to get our expected return. Some days are higher, some days are lower. So at the end of the term, when you expect to sell the stock, you want it to be as close to this line as possible. You determine how likely it is to be at that mean by its standard deviation. How many standard deviations is it away from the mean at any given time? If the standard deviation is large, it can essentially take one step and be very far away from the mean. If the standard deviation is small, taking one step doesn't take it too far above or below the mean. So that's our measure for how risky a stock is. It's our standard deviation. So let's say you don't want to put all of your eggs in one basket because nobody does. You don't just want to buy Google. You might want to buy Ford, Nike, Shell. What else do we have here? American Steel, Strum Ruger, and this is actually this is a proxy, so we're not actually going to look at that right now. But you want to buy some set of these in proportion to one another with your money so that you're not going to risk all your money on one stock. You're hedging your bets, essentially. So you have to look at the standard deviation and expected return of each one of these stocks and carefully weigh how much of each you want such that you get the expected return you want at an acceptable level of risk. So let's say, for instance, you have a high expected return in a stock, but that makes it high risk. That's typically the way it works. I mean, the perfect stock, which doesn't exist, is high return and low risk. The market doesn't allow that to happen. It's not efficient. So you want that high return, but you don't want to take the risk. You might lose your shirt. You want to take some of that high return, and you only want to take some of that risk, and you want to balance it with the other things in your portfolio. So that's kind of where we get to Shark Markowitz here. We have our individualized securities here, And this is the minimum variance frontier, this entire curve here. And it represents some proportion of all or some of these individualized securities inside the frontier. So here we have a high risk, high variance. Here we have, high expected return, high variance, and here we have low expected return, low variance. This is very safe, but it's not very sexy. It doesn't return you a lot. This is very unsafe, but your chances of winning are very high. So how do you weight these two such that you, along this curve, get a profile that is more acceptable? So the efficient frontier up here is the section we're actually going to be focusing on here, because below this line, you have your global minimum variance portfolio. This is the lowest point you want to take on this line. Essentially, this is going to be a given return for a given standard deviation. This is going to be less return down here for a higher standard deviation. Less return, higher risk, everything below this point here. So we essentially ignore everything below there because this is a losing strategy down here. It is very dumb to take that. We just cut it out and we look along the efficient frontier. And essentially, if we were, say, proposing an asset allocation to a client, or if we were building a mutual fund, what we'd have to ask ourselves is, what is our appetite for risk along this curve? If our appetite for risk is high, then our return is potentially higher. And if our appetite for risk is lower, then our return will be lower. So that's kind of like an individualized question. How much risk do you want to take on? And that will determine the weighting of these individualized assets along this curve. So do I have the Wikipedia up? Oh, I did. No, I do have it here, yes. This is the software that exploded on me earlier. So modern portfolio theory looks really complicated. Thank God it isn't really complicated, otherwise I wouldn't have been able to do any of this, or even start to ask smart questions about how it's done. So we have here a generalized formula to get, well, we should probably start here. Here we have, these are essentially our axes here, our expected return and our variance. And this will give you the expected return of a given asset and the variance of a given asset. So that will plot these fellas here, these individualized securities here. And then our portfolio return variance is going to be, we pick some proportion, some weighted proportion of these individualized assets and add them together such that we get a new asset with a new profile here. And here we have the sum of asset I, or sorry, this is the variance of this portfolio is the sum of asset I times the weight of that asset squared times the standard deviation of that asset squared plus the proportion of the other asset, essentially. So the sum of I and j naught I times the weight of I times the weight of j times the standard deviation of I times the standard deviation of j times the covariant coefficient of both I and j. And that gives you the whole thing. So this, the covariant area here is just the tough part for me. This is essentially how related the two stocks are. When one moves, does the other move proportionally? That would be a high level of correlation. Correlation would be bounded to +1 or -1. But covariance essentially is when one budges, does the other budge? Now, ideally, in a portfolio, you're not just going to hedge risk. That's quite simple to do here. This is actually kind of the magic modern portfolio theory, is this covariance element here. You're not just hedging the risk of your two individualized assets and pooling them together. You're also hedging against how related they are, because that's a component of the risk. So let's say that you have, like in our current times, the entire service sector just absolutely eating shit overnight because a virus has shut down the whole economy. So you have two assets. You have a bunch of Google, and you have a bunch of Jiffy Lube or some tire shop or God knows what service thing. I'm just thinking because my car actually needs to go in for service and it can't be done. So they're two unrelated stocks, right? Immediately, like one's a tech company, which typically has a higher risk profile but a higher return profile. although Google's actually pretty safe. We'll see that in a bit. So the other one is going to be, pretty low risk, pretty low reward. It's a retail business that's growing at a given rate. They don't make big moves. There's not a lot of acquisitions happening there. Standard deviation is going to be really low. So they're quite different assets in terms of risk profile, but they're also different in sector. One is a face-to-face business, the other is not a face-to-face business, and they're affected by different things in the market, such that if you had a really high proportion of your asset allocation in this face-to-face business and the total face-to-face economy tanks overnight, that asset is worth shit now. But that's fine, because you have your other asset in some given proportion where it didn't eat shit, because they're not their level of covariance is actually probably quite negative in relation to each other. So it's just another way of finding out how similar these assets are, because you don't want similar assets in your portfolio. You're trying to hedge against the qualities of one with the quality of another. So that's kind of our magic sauce here. It's covariance. We kind of have a bit of a rub here. This is really easy to do mechanically in Excel with two assets, and our first model actually used two assets because it was nice and fun, and I could see it all working nicely. And that's essentially when we look to check our weighting, we can essentially just brute force two assets really easily. You pick a proportion of one and a proportion of the other. Let's call it 5% of one, 95% of the other, and then you slowly adjust them such that you get all the combinations of 5% of one, negative 5% of the other. And then you take those weights and then you just plug them right into this equation here. And that's super easy because the numbers all line up, and you can essentially just drag the equation and get all of your various weightings and then see where it lies on this curve here. And you'll actually plot a lot of these down here and a lot of these up here, and then you'll just throw out everything down here. Where it gets kind of tricky is where you get more than one asset in the portfolio, and this is where the Markowitz magic kind of happens. And it's matrix multiplication, which is something I don't fully understand how to do exactly correctly. I mean, I know the variance covariance matrix is matrix multiplication, but that is a little more intuitive for me. But essentially, to determine our portfolio variance, we have the weight of an asset, asset A, right? The weight of that asset squared times the standard deviation of that asset squared plus the weight of asset 2 squared, or B in this case, asset B squared times the standard deviation of B squared plus 2 times the weight of A times the weight of B times the standard deviation of A times the standard deviation of B times the covariance coefficient of A and B. Really nice and straightforward because we only have A and B. We're only really doing this once. When we start to get into larger portfolios with more assets, you can see it kind of balloons because we need to get all the unique combinations of covariance coefficients. So we are, not coefficients. So we have here, and we're just going to focus on this back part here because it's the same as up top here. You have your weight times your standard deviation squared of A, B, and C, all pretty standard, plus 2 times the weight of A, the weight of B, standard deviation A, standard deviation B, and the covariance of A and B. Now you have to do it for A and C. Now you have to do it for B and C so that you get each covariance. You're comparing each asset's covariance to the other to determine how related the entire portfolio is to itself. I'm going to take a really quick break here because my timer is running out on this video, and I'm going to come back in a second one and bore the heck out of you there.